why it lost money. The insurance trap. The primary culprit is a 7% fixed allocation of puts. Here's exactly what happened. Constant drag. You allocated 7% of the entire account to insurance puts in a rising market. Those puts constantly lost value due to time decay and the rising price. Forced selling of winners. Because the strategy is programmed to maintain that 7% target, every time the puts lost value, the bot sold. Interesting. So that's why it's actually been buying a lot of these TQQ. The bot sold profitable TQQQ shares to buy more puts. That makes sense. Maybe we got to loosen this requirement a little bit. Result, you are effectively siphoning off all of your TQQQ gains to subsidize a losing hedge. 7% is a very aggressive allocation for pure long puts. Usually 1 to 2% is standard for tail risk protection. That makes sense. Okay, so some solutions, it's saying. Switch to put spread, vertical spread. How it worked, buy 15% out of the money put, but sell a further put, right? This kind of makes it cheaper. That makes sense. Or we could also just lower the allocation, right? Would recommend to do both. Switch to a put spread, buy 15%. Okay. Okay, let's do both of these options. Okay, and let's see if we can get this thing to actually work a little better. So we're going to make it so instead of just buying puts, we're buying a put spread. So it's going to make this cheaper for us to maintain. And then we're also going to reduce it from 7% to about 2 or 3%, which I think would make a lot of sense in both scenarios. Okay, so we're doing this change to our strategy, and let's see how this turns out. Okay, and coming back to this one that we're talking about, companies that have really high price to sale ratios. Like Palantir is just ridiculously expensive right now on a price to sale basis. Part of me wants to just make a strategy that simply like kind of copies Michael Burry. He's shorting Palantir. He bought put options, quite a bit of them on Palantir, right? I'm wondering, maybe that's just not a bad idea, right? Just Palantir. MicroStrategy is another one. MicroStrategy is a weird one though, because they don't really make money. So I don't know if I'd add that to the list here, because they basically just own Bitcoin. So they don't really have revenue. So I don't know if I would put this on the list of the ones I would want to trade. AppLovin, though, is definitely one of the ones that could be up here. AppLovin, I know it's been doing really, really well. I don't know if you guys have seen AppLovin. This thing has been a freaking rocket ship. Look at this. AppLovin over the past year up 122%, or past 5 years up 1,000%. This thing has just been a rocket ship, right? I think what do these guys do? They're mobile technology company. They do mobile advertising, marketing, app discovery, some stuff like that. So I think they do basically marketing and advertising in apps, and they've just been doing really, really, really well. But their PE ratio is pretty damn high. It's around an 84, and we're seeing that their price to sales is like 34 to 45. It's quite high, right? So the question is, maybe we want to be shorting this. Maybe this is something that might be a good idea for us to own some put options on. So if something goes bad, if the market explodes, this thing could make us a crap load of money very quickly. Cloudflare is another one that's quite high up there, right? These it's really all the AI stuff, right? It's the Cloudflare, the CrowdStrike, Broadcom is also around AI, Nvidia, obviously an AI company. So most of these are just AI companies that just have these really, really crazy valuations, and they're good companies, but are they going to have gains like this? Because this is pretty damn nutso, right? Okay. So, question is, do we want to make a strategy that just shorts these guys? What do you guys think? Would you make a strategy to short this? How would you guys go about doing this? Let's see. Make a strategy that buys put options, or if you were to make a strategy that buys put options on the top names here, how would you structure it? What percentage of the account would you use to buy the puts, so that the entire account does not blow up if they go up, but can make a lot of money in the event that they have a huge loss all of a sudden. So the expectation is that Palantir will still go up over the next few months, but will eventually get hit hard and drop like 80%. How can we position ourselves to make money in that scenario? Right? That's basically what I'm thinking here, right? Maybe 80% is a bit aggressive, maybe 60%, but like assuming, what if this was the scenario? What if Palantir is going to keep doing, is going to keep growing? Like this is what I'm thinking, right? Is that Palantir is going to keep growing. This is a high flying name in AI. I don't expect this thing to drop anytime soon, right? We did have a bit of a correction, but it's not like it was that severe. What I'm thinking is that Palantir is still probably going to keep going up for a little while, but the rest of these names too, they're probably going to keep going up for some time. But then we're eventually going to hit some sort of snag, right? And this happens in the economy roughly every 2 to 5 years, right? So the last time we hit something like this was in 2022 when we had this really high inflation. Before that was 2020. We had COVID, right? Things like this, they just always happen, right? Like this is one of the most predictable things in the world is that we're eventually going to have some sort of downturn in the markets that will happen at some point in time. I don't know what's going to cause it, right? Is it going to come from us? I don't know, maybe some new virus comes out, probably not. Maybe a war breaks out. I think that's a pretty likely outcome. Taiwan, Japan, and China have been fighting over Taiwan. That could easily trip a world war. You know, there's been a lot of war activity happening lately, which if the U.S. and China get dragged into a war, that's World War III, basically. What if that happened, right? What if, there's all these things that could happen in the economy, right? Like, what if a big bank blows up? What if, all these like possibilities? It's hard to predict what it's going to be, but I can almost guarantee you that something will happen in the next 2 to 5 years. Almost guaranteed, right? I would bet a significant portion of my money on that. And in that event, I would argue that these companies that are listed here with these extremely high price to sales ratios, these are going to be the ones on the chopping block. They're the ones that are going to get hit the hardest. So, what if this was a scenario, right? What if we had a strategy that basically didn't lose too much money if Palantir goes up? If Palantir and MicroStrategy and Apple 11, if they keep going up, we're not getting killed, right? We want to have something like that like it doesn't lose a lot of money when things are going up.